Hey, so here is a quick breakdown on a deal that we saw just pop up in our network from our scraper here. And so you guys asked for breakdown, so I'm going to give you a quick breakdown here. So this is a pretty interesting deal, 2.2 million healthcare space, 25% margins, 13 years old. They've already pre-qualified for an SBA. The only kind of big thing that's kind of up in the air here is this here, the semi-retirement and the support and training. But that said, let me kind of go through this deal. So biggest pros, really, it's healthcare. Healthcare is always hot. It's always continuously growing, at least right now for the next foreseeable 10, 15, 20 years. It's going to be in a growth mode. This one does seem to be based or focused on elderly patients as the base, as we've kind of looked at it and seen some data here. Which does mean long-term cash flow, right? If your overall patient base is, 40s, 50s, 60s, you have folks that are going to continuously need to come back and come back and come back. So that's what it seems like it's set up as. It also has insurance set up here where there's guaranteed levels of income. Obviously, this needs to be verified, but that's a good thing. Having consistency in cash flow in the physical therapy space is somewhat hard. Occupational and speech therapy a little bit less hard because this is like these are long term things that need to be dealt with. But their loan scenario they've pre-qualified with also isn't too bad. So they've attached a teaser here and they've got some, actually they have it here too. They've got some okay terms, 120 months. So they've done a 10-year, they haven't done a push out of interest only or anything like that. And they've got an 11.25% pre-qualification here. Not bad, not great, but not bad. Some of the biggest cons here is, I mean, this is a 13-year-old business. It may sound like it's great, like it's decent period of time. It's not really for these types of businesses. Normally, when we look at a lot of these, like healthcare, especially ones where there's a lot of high trust that's needed, I mean, we want to see 20 years, 30 years, 50 years in business if we can. 20 years more likely in healthcare, 30 plus in service based. So when you're talking trades, home services, things like that. So not horrible, really not horrible, but also not great. And one thing they're also kind of putting up here, which is probably the worst three flags. One, they're saying $355,000 down for a qualified buyer, meaning they're effectively saying that they do not want to front any type of seller finance in this transaction, even though the seller is going to get, 75, 85% cash. They're basically saying the seller wants all cash. That's not a great scenario, right? It's a high level of risk. Especially, if you look at the teaser here, they have grown slightly, but their profit's gone down. Now, obviously, this is discretionary earning. This is not real profit. So who knows what that's going to look like when you look at the real numbers. But, that's a pretty big flag. I'm assuming that's probably just the broker that did that. So you never quite know. But there's a good chance that they change that up before they actually close a deal here. The other is these two down here that I already kind of mentioned. So semi-retirement, not always great. That's kind of a red flag. They're going to be taking this cash and dumping it into something else. So this is the beaten stepchild of sorts. And support 4 weeks at zero cost to the buyer. It's a very short period of time. One thing you're going to notice here with a lot of on market, you don't get this with off market. On market, you see consistently 4 weeks, 5 weeks, 6 weeks, maybe someone's even 2 weeks. That's not enough time to reasonably transition a business when there's all these different processes and things to come in with, especially if you're not coming from this industry. If you are already a physiotherapy clinic owner and you're already running similar type of things, you're probably still going to struggle to transition in 4 weeks, to be super blunt. But realistically, when you're coming from outside industry, you want 3, 6, 12 months of commitment of availability. Maybe it's only 3 or 6 months of hands-on, but you want commitment that they're going to be there to transition properly, because otherwise you have this scenario, and we've seen this time and time again with folks where they buy a business and 12 months out they're barely above water because they didn't structure and negotiate a transition that makes sense. And so they're having to go back and pay the previous owner massive consulting fee just to try and keep the business afloat. And all of a sudden, they're burning cash. And with ups and downs of the economy, not so much in healthcare, but in other service businesses, that's a big flag. That's something you definitely don't want when you're dealing with a multi-million-dollar asset. That it's very easy for it to go flip side belly up, where you're burning 30, 40, $50,000 a month. And all that said, kind of quick metrics breakdown. I already looked at it's 25% margins, give or take, based on what they've calculated here. And so, effectively looking at a loan amount of 1.87 million, interest rate 11.25%, loan term 10-year. It's not a horrible payment. It's pretty decent, to be honest, but it's effectively about 1.6, 1.7 times free cash as they've calculated, at least, which is not horrible, but also not great. What you really probably want is more. You're going to pay maybe 75% of this. The owner's going to hold a note for 25%. And in that scenario, let me just quickly calculate here. Your loan's going to be 1.65 instead. And so on 1.65, similar interest rate here, you're more closer to your 2 times debt service ratio, which is usually the golden ratio we're after, meaning you're netting 500 and some thousand in net profit on the annual. Of course, these aren't vetted full numbers, but give or take 500,000, and you're paying out round about half, right? So your total profit is twice as big as the amount you're paying for debt. So debt service coverage ratio, DSCR, is just a calculation based on that. It's a ratio based on that. And so our kind of gold standard is if we can get a deal to 2 times DSCR, meaning we profit $500,000 and our debt service is only $250, that's perfect. That means we got a lot of room for error, which is what you want, especially when you're coming out of industry. Now, it's not always possible. Most SBA loans fall into 1.6 to 1.8, but that's kind of what you want. Whereas this is not quite at that range. You definitely want to negotiate it to something more like 75% cash, or even better, 70% cash, 30% as a note. And the more you can take down there is from the payment in full up front, the easier it's going to be to debt service, and the easier it's going to be for you to transition and get this growing, and so on. So for this to be a super sweet deal, you can be at probably somewhere in this range, 1.55 million. You're pretty easily in that range of a 2 times, assuming there's some a good amount of this is ideally real, but you never know. But assuming that would be a good deal for you in terms of something that we would look at for sure. And this actually is one that we're looking at for someone we're working with, trying to get an E2, because this actually qualifies to run for an E2 visa. So I think they actually mentioned it there. I think they promote it as that too. But yeah, so interesting deal. I thought I'd give you a breakdown, and obviously let us know if you have questions or you want deeper dives in certain things for the next breakdown.